for everybody. And so that way we'll send it out to you, and then we will also have it there for anybody that may not be able to attend. I want to thank Neighborly Ventures for setting this up. We teamed together a couple months ago and really wanted to offer a value-added service to everybody, so that way you can learn about home buying experiences and how to buy a home. So I do want to make sure that I am sharing the correct screen. So I'm just going to do that one more time here. I don't see my box around the screen, so perfect. Okay. Okay, perfect. So yeah, we'll talk a little bit about land loans as well. Those are different, but we will talk about that a little bit here as well. So make sure that I answer that for you. So again, want to thank Neighborly Ventures for setting this up. One thing that they've looked at is ways to be able to add value to you guys. They're not a typical type of a landlord where they just want to make sure that you're paying their rent and that, but they really sincerely have an outward mindset, and they consistently look for ways that they can add value to you. And so when we talked about teaming up and offering this to everybody there within Neighborly Ventures, they've got, I don't remember, 8-10 apartment complexes or so. We wanted to do that, and two things. One, they wanted to add value, and then one, I wanted to add a monetary value. And so anybody that works with us on a mortgage, so we help you get pre-approved in that. We do give you a $1,000 discount on your closing costs, which that can be pretty significant on closing costs. So anyway, as we start to go through, let's start to go through and start to answer some questions. So I'm gonna pull this on over here for myself. Okay. So Freddie Mac, they talked about why pre-approvals should be your first step, and that is your first step whenever you're looking at buying a house, is to get pre-approved first. And so before you go out and look for houses and get your sites set, today I ended up talking to a couple that they were really looking for around $400,000, and the most we can get them qualified for is $355,000. And so that really shattered their dreams of this house they really liked. But it's always best to know what you qualify for first before you go out. And Freddie Mac, they said, it's highly recommended that you work with your lender to get pre-approved before you begin house hunting. Pre-approval will tell you how much home you can afford, and can help you move faster with greater confidence in competitive markets. And right now we have a very highly competitive market. And so, and I'll talk about the levels of pre-approval that we do to be able to help to where you can qualify for potentially more house, but also how you can get your offer accepted in a competitive market. So the chief economist with Zillow, he said, again, just bringing forth this pre-approval aspect, getting pre-approved for a mortgage and finding an agent you can trust can go a long way in helping buyers act quickly once the right home does become available in this otherwise tight and stressful housing landscape. So how do you get pre-approved? And what's the process? The first thing is you set an appointment with us. Second, we're going to take your application, and that's a baseline. We always want a baseline of where we're going to start and what we're doing. During that application, we will pull your credit. Again, we want to establish that baseline of where you are, so that way we know what we can do moving forward. We're going to ask for a lot of supporting documentation. We'll then send that in, so then the underwriter reviews your loan and approves it. Once you have an accepted offer, we will then order the appraisal. Whenever you get a loan approved, it's going to be approved with conditions. And so with those conditions, we're going to start to satisfy those conditions. We send those back into the underwriter. The underwriter then gives a final sign off, and then we'll then order loan documents to where then you go into the title company and then you'll sign. So typical title companies, you may see them around town: Ticor, AmeriTitle, First American, and Fidelity. And so you go in there and you'll sign loan documents. You sign the majority of your loan documents online with us before you go in, and then you'll sign about 5-6 documents when you're actually at the title company. And then a day or so later, your loan funds, and when it funds, then you can move into the house. So that's a whole process here that normally takes around 30 days to be able to do. And with that, you know, we can shorten it up to around 2 to 3 weeks. You know, and so it's really as fast or as slow as you want to operate. But that is the process right there. So why so much paperwork? And I always like, you know, cartoons and things like that. And so after the big mortgage mess, we're being a bit more careful these days. I'll need your tax returns, financial disclosure documentation, plus letters of recommendation from the Chairman of the Federal Reserve, the President of the United States, and Oprah, and the Pope. Sometimes it feels like that when you're trying to get a mortgage. And the reality is that some of the paperwork that we ask for can open up other cans of worms, in essence, that it can open up other areas that we need to look at. And we'll talk more about that here as we go forward and what I mean by that. But ultimately, just note that we really don't want to ask you for anything more than we really need. And we're going to tell you one thing that my team and I do is when we do ask for something, we do give you the why behind it. We find that if you don't know the why behind it, then it creates a very stressful environment. And so we want to give you the why behind it. So again, why so much paperwork? And it really stems from 2008 and the mortgage meltdown that we had in 2008-9 in there. And the government they set new standards to make sure that each bank, each lender proves beyond a shadow of a doubt that you're capable of paying the mortgage. And you know, it's not just that you're a good person, that you promise to repay, but no, we now have to truly prove. And then even with COVID right now, it's even prove and then reprove that you have the ability to pay. And that helps our economy. That helps us to be able to write good loans and that. And just kind of a side note at this point, some things that people have started to, you know, that I'm starting to hear from some clients is that that there's going to be a lot of foreclosures out on the market. And that really is not the case. And so that's due to COVID and the fact that there's a portion of the population that isn't able to make their mortgage payment. And with forbearance and that, it could cause some foreclosures. That's what some people have been thinking. But the reality is that for the last 12 years, plus 12, 13 years or so, we've been writing really good, strong loans. And the average person that owns a home today has at least 25% equity in their property. So with that, that's different than 2008, where in 2008 and 9, people didn't have equity in their property. Their house was actually worth less than what they owed. So for them, it was easy to be able to walk away. If you couldn't make your mortgage payment, then you stayed in the house until you were foreclosed upon, and then you just walked away. But now it's a lot different. And so people, they've got significant equity in their property. And as they have that significant equity in their property, they're not going to just walk away. They're going to end up selling their house. And right now, and into the foreseeable future that we see with interest rates where they are right now, it's looking more and more like it's going to be a seller's market for the next at least year, 2 years or so, because right now we've got about a month and a half worth of supply in the market. We go through, as the multiple listing service in this area here, we do around 1,200 transactions a month. And with those 1,200 transactions a month, we have around 1,700 houses on the market right now that do not have an accepted offer on them. So there's more than that, but the ones that do not have accepted offers are around 1,700. So that's about a 1.5 month supply, meaning if no new homes hit the market within the next month or within the next few weeks, then we will end up going through all those properties and we'll sell all those properties within a month and a half. So, And I'll go through supporting documentation here in a little bit, Peter. So thanks for asking. And again, what do we ask for? Excuse me. So we're going to ask for a copy of your driver's license and social security card. Excuse me. We're going to ask for your last 3 months bank statements. And that's all pages of your bank statements. And it is actually your bank statements, not your transaction history. So your bank statement, typically it's not mailed out anymore, but you can go onto your website and get a copy of your actual bank statement. It'll show your account number on there. It'll show the logo of the bank, your name, and then all your transaction history in that. But it's not your transaction history, it's your bank statement. Also, your last investment account. So if you have like a retirement account or 401k or 529 or any of those plans, we would ask for the last statement on that. We'll ask for your last 30 days pay stubs. And I will state that this is an area due to COVID right now. We will ask for your 30-day pay stubs. We'll get that. We're going to get a verification of employment from your employer as well. And then when we get ready to fund, we're going to ask for your updated pay stubs to confirm that you're still working. And we're also going to get another verification of employment from your employer at that time as well. So there's a lot of, with your employment right now, there's a lot of checks and rechecks and balances due to COVID and so many people being out of work. We're going to ask for the last 2 years of your tax returns. Again, that's all pages of your tax returns that you sent to the IRS, and also a copy of your W-2s. Excuse me. If you're self-employed, we're going to ask for a profit and loss statement and a balance sheet for this year to show your income for this year. And of course, you guys are renting, and so we're going to ask for the name and address of your landlord, which we know who that is. And then also, if you're retired and receiving Social Security, we're going to ask for your award letter for either disability, retirement, or Social Security, whatever that may be. If you're declared bankruptcy, it's going to be all the pages of your bankruptcy papers. So typically, that's 50, 60, 70, 80 pages. There's a ton of pages there. Plus then the 2-page document that would be your discharge notice. So whenever you declare bankruptcy, there's the actual documentation that goes to the court that says, I'm declaring bankruptcy on these debts. That goes out to your creditors. Creditors then have an opportunity to say no. They can contact the court. But when the bankruptcy is all done, then there's an actual discharge notice that says everything's discharged, everything's done. So we need that as well. So if you've been divorced, really over the last about 10 to 15 years or so, then we're going to need a copy of your signed divorce decree. And then if there's any settlement there, any child support payments, alimony, anything like that, then we'll need that documentation. And I already said that there. So that's really the list. And this is where it starts to get, this is our first list of paperwork that we're going to need. We'll send all that into the underwriter. And some things that we see would be, let's say that you make $3,000 a month and we get your bank statements and we can see the deposit of $3,000 a month going into your bank statement. But then all of a sudden we see a deposit of $8,000 hit your bank account. And it's outside of the norm of your $3,000 a month deposit. At that point, we would then need, documentation of what that $8,000 was. Was it an automobile that you sold? Was it maybe some work that you had done? What was it? And then, and if you sold something, we'll need the sales agreement that you had. We'll need a copy that if it was a car, a copy of the title that you have the ability to sell the car, and then the paper trail of that documentation. If that $8,000 was a gift, maybe from mom or dad or brother or sister or whoever, and it was a gift for you guys to buy a house, at that point we would need gift documentation. So we just need a letter from them stating that it was a gift. There's no obligation to repay it, and then proof that giftor had the ability to give the money to you as the giftee. So a copy of their bank statement showing that they had the ability. Now, the reason why we have to go into their bank statement and make sure that they had the ability is to make sure, and that's really more of a, I had it on the tip of my tongue, but a Patriot Act issue. And so we need to be able to track money as to where it came from and why it's in your account. So if it's a gift, that's, again, no biggie, but ultimately we need to track that your mom and dad had the ability to give the gift. If they didn't have that ability, but all of a sudden, they gave you a gift, well, then we have to track, well, where did they get it from? So was it a loan or what, what was it? So hope that answers that question there. There's a lot of documentation that we need. Now, as we go through really, and I call this your unfair competitive advantage. And so in working with us, there's really 3 different levels of pre-approval in our industry right now. There's a pre-qualification, which is really as good as, a phone call. Hi, my name is such. I make $1 million a month. I have $10 million in the bank. I've worked for my employer 180 years, and I want to buy a house. How much do I qualify for? That is really, those are the phone calls that, well, you're qualified for, $50 million, whatever. Really good for nothing. It's just a conversation on that. The next level beyond that is a pre-approval. And so getting an actual pre-approval. With the pre-approval, really what that is we've taken your loan application, we've gathered your supporting documentation, we've reviewed everything, we've then put you through one of 3 different pre-approval engines, internet engines. One is either DU, Desktop Underwriter, LP, Loan Prospector, or GUS, G-U-S, GUS. GUS is for USDA, and then Loan Prospector is for Freddie Mac, and then DU is for Fannie Mae, and also for FHA and VA. So we then put all your information into the computer. We then run you through that automated underwriting engine, and it kicks out your approval. You're good to go. And then you go out and look for a house. Now, that's the industry standard of pre-approvals these days. And with that pre-approval, you're going to close anywhere from 30 to 45 days. And with that, we want to make sure that you're a little more competitive in that. And so what we do is we call it a platinum credit approval, but we will actually fully underwrite your file. We'll send your file into an underwriter, have them put their stamp on it. Yep, you're fully approved. And now the beauty about that is that we shed about a week to 2 weeks worth of time off of your loan time frame. Now we can close in as little as 2 to 3 weeks instead of 3 to 6 weeks or 4 to 6 weeks. And now when you're making your offer, your realtor then will, when they send in the offer to the listing agent, they'll CC me on it. And so it's always emailed. And then I call the listing agent, let them know that you're fully underwritten approved and that you're as good as cash. The only difference is we need an appraisal and a title report. That's it. And where cash may not need an appraisal, but they're going to get a title report. Why that's so significant is because we can close in as little as, again, 2 to 3 weeks, where cash can close in as little as about 1 to 2 weeks. So the other thing is that the pre-approvals by the industry standard, we're finding around 25% of those aren't going through. And so with that, you may be looking out on realtor.com or Zillow.com or whatnot, and you may see comments on a specific property that said, this house is back on the market, not to any reason of the buyer. I'm sorry, any reason of the seller or the house. And so with that, they're alluding that it was the buyer's financing. They may even say the buyer's financing fell through. But ultimately on the full underwritten approvals, they're really as good as cash. And so we've been able to help multiple people get accepted offers just because you're fully underwritten approved, not just pre-approved to the industry standard. So let me check, see if there's any other questions here. Okay, not yet. So there's one myth. We'll go through a few different myths here, but the first myth is that your credit has to be perfect, and that really is not the case. So the reality is that 52% fall within a 600 to a 749 score, which is not perfect credit. It's and 700, 749, that's good credit, but it's not perfect credit. Perfect credit is 800 plus score. So that would really mean that 13% of the population that buy a home in today's market actually have perfect credit. 33% have really good credit, 750 to 799. And then the rest fall within that, 52% fall within that 600 to 649. Now, prior to COVID, we could go down to a 580 credit score. But because of COVID and the tightening of the markets over the last couple of months, right now we go down to a 620 score. If scores are below that, we still want to work with you. And what we're going to do is we're going to treat you as if you have an 800 credit score right now. We're going to get all your supporting documentation, take your application, pull credit. We're then going to counsel you on what you can do to help your credit scores go up. But we want to get you ready to where as soon as, if scores go down to, let's say that you have a 605 and scores go down to a 600, we want to then be able to call you and say, hey, scores now are at we can go all the way to 600. You can buy a house now instead of having to wait. So I hope you understand that. So, and then there was a question about student loans. So student loans right now, the way that those are affected is people are not making payments on student loans, but depending upon what path we're going, whether we're going Fannie Mae or Freddie Mac or FHA or VA or USDA, we will have to hit you with a payment of anywhere from 0.5% of your student loan or 1% of your student loan on a monthly basis. So if it's $50,000, we're going to hit you with a payment of anywhere from $250 a month or $500 a month, depending upon the path that we're going, unless you have a specific payment already, a payment plan already with your student loan company. And then if you have that and you have proof of what your payment is and you've been making those payments consistently even during COVID, then we'll use that payment. So the second myth is that I need 20% down payment. And that really is not the case. So there's really four main loans in our market today. And that is USDA, which is a 100% loan. Now I have the credit scores here I have are pre-COVID. So we'll get back here, we'll get back to that level. Ultimately USDA is a 620 score right now. FHA is 620, conventional is 620, and VA is 620. But pre-COVID, we were down to a 600 credit score. And again, we'll get back there. It'll probably take us, I anticipate, until December, January, probably in there somewhere. We're starting to see one thing that we had beforehand was also another 100% program, which I'll talk about that when it comes out. But it was actually a 101% program to where you can have 1% to be able to cover some of your closing costs. But anyway, USDA is a 100% loan, 620 score right now. And USDA, you have to buy a house in outlying areas. So that would be Independence, Monmouth, Turner, Sublimity, Almsville, Staten, Jervis, Amity, areas like that. That's where you can buy a home at. So it really is not pertaining to buying a house inside the city limits of Salem. However, there are a couple of outlying areas of Salem that you can buy. Same thing with Kaiser or Albany, Eugene, Corvallis. So, but again, in the outlying areas, there are some areas that you can buy with the larger populations. And then FHA is a 3.5% down program. And we used to be able to go down to 580, we can go down to 620 right now. FHA has some pros to it, where FHA has the ability to be able to go to a higher debt to income ratio. And it also has lower, if your credit scores are a little lower, it has lower monthly mortgage insurance on it. So there are some pros to that. The downside to FHA is that you have mortgage insurance the whole life of your loan. So And then conventional, right now we've got 3% and 5% down. Again, we will, and I'm anticipating that we'll have this back in about October, November is what I'm being told. But that will be a 101% program conventional. But right now we have 3 and 5% down, 620 score. And then VA, VA is 100% financing with a 620 score right now, 600 before COVID. So there are upfront costs and so when you're buying a house, and those upfront costs typically are going to be the earnest money. That earnest money you put down on the house just to tie it up, and it used to be around $1,000 or so, but right now, because of the competitive market, a lot of time it's about 1% of your purchase price. So let's just call it anywhere from $1,000 to 1% of your purchase price. Home inspection is around $375 to $475, could be a little bit more than that, and that's where the inspector goes in and checks everything out, checks the furnace out, the water pipes out, checks the pests, the dry rot, all of that stuff. There's also other optional inspections, anywhere from $150 to $500 for radon and different things. Roof inspections, foundation inspections. I've been finding a lot of clients have been doing sewer scope inspections. And so one client, I would suggest that. I mean, I had one client that found out through their sewer scope that that their sewer pipeline was actually sloping down towards their house, which, if the stuff that's in there runs towards your house, that's not really good. You want it to run away from your house. And then an appraisal, is $800 plus right now. And so for our clients, they pay $800. We actually pay $1,020 for the appraisal, and we credit you $220 on that. So we support on the $800 of the appraisal. And the appraisal tells us the value of your house, opposed to all the other inspections are specifically for you. So when buying a house, there's closing costs, and there's really 2 sets of closing costs when you're buying a house. Everybody lumps them into one, but there's really 2 sets. There's closing costs, which are just one-time fees. So the appraisal, processing, underwriting, doc prep, credit report, flood certification, all title fees, escrow fees, recording fees. Closing costs are only things that you have one time. You never have it again as long as you have another loan, unless you do another loan. But there's also another set of closing costs, and those are called prepaid closing costs. And prepaid closing costs are taxes, interest, and insurance. And so those are the closing costs that I call that never sleep. Those are also the most expensive of the closing costs. Right now, we're collecting a full year's worth of taxes, real estate taxes. We're collecting a full year's worth of homeowners insurance, and then interest for the month that we close. One thing that's nice when you buy a house is that if you were closing this month, we would collect 6 more days worth of interest here this month, but then you would not have a mortgage payment next month. You always skip a month, and so your first mortgage payment would start October 1. You always live in the house first, and then you pay. October would be paying for living in the house in September, where it's exactly opposite of renting. So September you always pay to live in your apartment before you've lived there. So now closing cost strategies, as we went back through here, with the down payments, FHA is 3.5%, conventional is 3 to 5%, USD is 100%, and VA is 100%. So if you have a conventional loan at 3% down, let's just say it's $100,000, you're going to pay $3,000 for your down payment, but then also you've got closing costs on top of that. And those closing costs they average around 3 to 3.5%, maybe even 4% of the purchase price as well. So now you're saying, well, wait a minute, Walt, I not only need the 3% down, but now I need another 3 to 4% for my closing costs. Well, it's not necessarily the case. I can tell you that in this market right now, more likely than not, that's probably the case. However, there's still a lot of ways to be able to work that out. So let me run through this. So there's 4 strategies in paying closing costs. The first one, the best one is you pay your own closing costs. That's going to make your offer as competitive as possible. A lot of people right now don't have money for the closing costs. So that's just a reality. They've saved up enough money for the down payment, but they're just strapped for those closing costs. So the second option is that the seller can pay those closing costs. Typically, the seller's not going to be that nice in this market and just pay your closing costs. So really we go into option 3, and option 3 is that we increase the price of the house to cover those closing costs. And that's happening more and more right now, where we're increasing that price of the house to cover those closing costs. And then the seller pays your closing costs that way. So they get more than what they were asking for, and then they pay those closing costs for you. The only downside to that is that the house may not appraise. So we really need to look at the counsel of your realtor. And we do work with some of the best realtors in the Valley, so we can refer you to one. But ultimately, when you make that offer, even though you may be underwritten approved, if you're asking for closing costs on top of that, then the listing realtor is going to let the buyer know, the seller know the house may or may not appraise. So they need to do their homework. And then number 4, we increase your rate to cover closing costs. The only time that that's a good idea is if you're really going to be in the house maybe 3 years or less, but potentially really 2 years or less. If you're going to be in the house during that period of time, then it may make sense to increase your interest rate to cover those closing costs. But if you're going to be in there 3, 4, 5, 6 years, 7 years, at that point, it would not make sense. So myth 3, buyers pay their realtor's fee. And that simply is not the case. So the listing, the seller of the property is the one that actually pays your realtor's fees. And so typically those fees are going to be anywhere from 4 to 6%, depending upon the purchase price of the property. So a higher priced property, it may be down to 4%. A lower priced property, it may be 7%. So, but the seller is the one that pays those fees. So the process of buying a home on the realtor side, there's going to be an initial appointment that you're going to set. The realtor is going to ask you if you're pre-approved, and that's going to be one of their first questions. Is are you pre-approved, before they'll ever start showing you houses. And then they're going to help you search for houses, typically online, and they'll have different tools for that. And then at that point, they're going to ask you to outline certain houses that you want to see, and then they'll set appointments for you to be able to go view those houses. So, So there's the initial home buying process. Sorry, I didn't go through the individual there for you. But again, initial appointment, pre-approval, search for homes, and then view the homes. So home buyer myth number 4, interest rates are the same. And again, that really is not the case. I have clients all the time calling me, and I had a gentleman yesterday call me and say, what's your best rate? And in talking to him, found out that for him, he's really not going to keep the money for more than maybe 6 months to a year. He's got a house in Eastern Oregon that he's going to sell. He's going to move here first. The house is paid off, but he wants to move here first, buy the house here, move in, and then when he sells his house there in Eastern Oregon, he then will come on over here and then just pay off the loan. So for him, he doesn't really care what his interest rate is. He can have a higher interest rate, but he cares more about his costs getting into the house. So for him, it's really the best thing is instead of the best interest rate, it really is the best strategy for him. And I will tell you that strategy trumps rate 100% of the time. So for instance, with him, if he had a really low interest rate, he could have burned $3,000 or $4,000 or $5,000 with that rate, instead of having a higher rate, and maybe he spends an extra $6,000 or $7,000 or $1,000 worth of interest over a 6-month period of time instead of the cost to get that. But there's ultimately 30 factors that are involved in every rate decision now. And take the strategy side out of it, there's actually 30 factors. First one is really loan amount, and then loan type, loan term, whether it's a purchase or refinance, If it's fixed or whether it's an ARM. If you're doing a refinance, are you pulling cash out? What's your loan to value, your combined loan to value? What property state are you buying in? The reality is that unfortunately, the Pacific Northwest, we have some of the highest rates in the nation. With that said, though, California has higher rates than we do. What county are you buying in? Is it a single family residence or a condo? Are we looking at 1, 2, 3, or 4 units? What's the occupancy type? Is it owner occupied or investment? What's your credit score? Credit score has a very large factor on what your interest rate is, but it's not the only factor. What's your credit history? So all of these, whether you have reserves after the fact, after you've purchased your house, how many months worth of reserves do you have sitting in the bank account, in your bank account? What's the lock period? Whether we're 7 days, 15, 30, 60, or 90 days. The longer the lock period, the more that's going to cost, the higher your rate will be. And mortgage insurance. Not many people know that you can actually buy a home with no mortgage insurance. You can put 3% down and not have mortgage insurance. If your scores are high enough, you can actually buy that mortgage insurance out. So that can be an option. Whether you have your taxes and insurance with your monthly mortgage payment or separate from. So there's a lot of different factors. The reality is that today, interest rates, if you call me and say, what's your interest rate? It can be anywhere from 2.5% to 6% on any given day. It's just dependent upon those 30 factors. So no two people get the same rate. They get a variation of the same rate, but no two people have the same. These 30 factors are called loan level pricing adjustments. And so no two people have the same exact loan level pricing adjustments. And of course, you know that mortgage rates are very, very volatile. They go up and down consistently. In fact, they're really changing we're back to about hour by hour. But those are some of the changes here. Just recently, this was, if you look at this time here in the middle, this was the time really kind of mid-March where all heck was breaking loose in the markets. And interest rates were changing by about a point to a point and a half a day. Some of these movements here, you can see they were pretty significant during that period of time. And this is actually the time that the Fed stepped in. First, there was the first stimulus plan that really not many people talked about. And so our stimulus plan ended up being a little over $3 trillion. And so people are talking about the 2.3 trillion, 2.2 trillion that went out to everybody. But they're not talking much about the other trillion that was spent to bail the banks out. So the banks were actually bailed out first throughout this whole process. And so they've done that. The Fed did that because they didn't want to run on the banks. And so if you think back to It's a Wonderful Life, the movie It's a Wonderful Life, which you can see a million times during Christmas, it's on all the time. But during there, George Bailey, he was wanting to get out of town. He had just gotten married, and he and his wife were sitting there in a car. They're getting ready to go to the airport, get out of town, and he had a chunk of cash in his pocket, if you remember that. And he looked out the window, and there was a run on the banks. It was 1929. There's a run on the banks. Well, as he went inside to find out what was going on, he found out that the bank was getting ready to close, and that people wanted their money. And so they needed to be able to help people that day to be able to stay in business, but they needed to have that cash. So he sacrificed his vacation, his honeymoon, to be able to make sure that the bank was liquid enough to take care of the customers that day. And so if you remember, there was the first client that said, I want X amount of dollars that's in my bank account, and you can close out my account. And he said, no, we're not going to close out your account. Here's your money, but please work with us. And then the next one was, there was a little old lady that said, I want all my money in my bank account. And George had said, please, not all the money. How much do you just need? And she said, well, if I could have X, and it was just a smaller amount. And he said, bless your heart. And he gave her that. Well, that's really what happened is that during this period of time in March, the stock market was going crazy. There were margin calls because the stock market went from 28,000 points down to 17,000 points. There were margin calls. The investors went to the bank. They went there for their money. Well, the thing that George Bailey taught us is that the bank makes money by lending out the money that you have in your bank account. And so, well, just like in 1929, our banks, that's how they make money. They lend out their money. It's called arbitrage. So they give you maybe 0.5% per year for your savings account, but then they may give out that money at 2, 3, 4, 5% for an auto loan, a personal loan, or whatever. Well, what happened is that the bankers went to the bank, or the investors went to the bank. Not all the money was in the bank. So there started to be some concern. At that time, the Fed stepped in and infused the banks with $1 trillion to make sure that they could match all the margin calls, then give the money to all the investors and that the investors had in the bank, because that money was already lent out to other people. So through there, then the market started becoming more stable. As you'll start to see in April, the market started to become more stable. And really the Fed has kept it stable since then. They've been buying a lot of mortgage-backed securities, keeping our rates really within a really good realm. So that's how the bond market works, and that's how rates work. So really, anytime that you're looking at buying a house, there's really 3 factors that we look at and that we go through that we feel really make a smart mortgage decision. And that is, first, you need to look at different loan options. So one thing we do is, after we've taken your loan application, after we've got your supporting documentation, we're then going to have a discovery meeting with you, you and your significant other. And so that discovery meeting, we're going to look at all options. We're going to look at VA if you're a veteran. We're going to look at FHA. We're going to look at USDA, and we're going to look at conventional. We're going to hone down or discover what the best loan option is, and we're going to do that by analyzing, and it's through a program that we call Mortgage Coach and a total cost analysis. We're going to analyze what's the best option for you to then be able to buy a house. What's the best loan option for you? And then from there, then we're going to look at, on a yearly basis, as we have mortgage reviews, really looking to see how we can reduce your debt over time. That's going to be the biggest thing. We were saved a couple weeks ago. I kept a running total, and through refinancing and other things that we looked at with clients, we were able to save clients over $800,000 worth of interest that week, so on their mortgages. So we're going to look at consistent ways to be able to do that. So as we're looking at loan options, again, this is the total cost analysis that we're going to go through. And I just ran a few scenarios here. So this is FHA, USDA, and then the 3% down. Big thing is that FHA is 3.5% down. So you're looking on $300,000, you're looking at a 10.5 down payment. Conventional is $9,000 down, and then USDA is, of course, 0 down. And then loan amount. FHA has a mortgage insurance financing fee that's financed on top of your loan amount. It's 1.75%. So that's included in the loan amount. USDA has a 1% finance fee that's financed on top of the loan amount. So that's why you see a loan amount of 303. And conventional has just their normal 3% down. You'll notice that interest rates a lot of times mirror FHA and conventional, where USDA is a little bit lower. But here, we look at the total payments, and at $300,000, your total payments roughly $1,876 on FHA for principal, interest, taxes, and insurance, and it's roughly $1,734 for USDA and $1,797 for conventional. Conventional is not the cheapest, where USDA is, but USDA, again, you're kind of in certain areas that you can buy, where conventional is going to be mid-range and relatively close, within $100 or so of FHA. Again, FHA, You have mortgage insurance the whole life of the loan. It will not go away. Where conventional, when you have 20% equity, you can get rid of that mortgage insurance. We also analyze tax brackets or tax benefits when you buy a house. And so if you didn't change any of your withholdings, you get roughly $2,400 back on an FHA loan when you file your tax returns, and about the same amount for the other loans. And so we look at your net monthly payment, and then we look at your cash to close. So we're going to analyze all of those things and again see what really makes the most sense for you. As we do that, we again look at payments. And payments, we're going to break out taxes, insurance, mortgage insurance, everything, and see what makes the most sense for you. Again, if you know what, we helped one client not too long ago who she qualified at 300. She had great credit, but they really wanted to buy around 340. And so with that, we bought out the mortgage insurance premium, cost about 1% of the loan amount. We bought that out, got rid of the mortgage insurance, added that to her monthly payment, and then she was able to qualify for all the way up to 350. So those are some creative ways that we'll start to look at, and strategies that we'll look at to see, again, what makes the most sense for you and how can we help you get to where you want to get to. We'll look at closing costs. So again, as we look at closing costs, you've got your APR fees. $14.93 is what we charge to do a loan. And then you're looking at your non-APR fees. That's the appraisal. That's the rest of the closing costs. The appraisal, the credit report, the tax service, escrow fees, recording fees, all of those fees. You've got the mortgage insurance premium if you're going FHA, or if you've got USDA, again, that's financed on top of your loan amount. And then you've got the prepaid closing cost. That's your taxes, interest, and insurance. And then the seller can contribute up to 6% of the purchase price on FHA towards the purchase price in USDA. So if your purchase price is, let's say $100,000 for round numbers, they can contribute up to $6,000 towards your closing costs. Where on conventional, they can contribute up to 3% of the purchase price. Again, the reality is closing costs are around 3 to 4%, depending upon really the price range that you're looking. So yeah. So there's common hangups that I really wanted to cover with you guys. And those common hangups are large deposits, new credit inquiries, insurance, who you're going to have for your insurance, gift fund requirements for the donor accounts, cash deposits. That's a big no-no. Moving money around between your accounts, that makes things really tough. Down payment, whether you have it or you don't. Timing of documents received. When we ask for stuff, we need it really quick. And then really creating that sense of urgency. A few don'ts would be, don't call the realtor on the yard sign to show you the house. That realtor works for the seller. They don't work for you. And so, so you want your own representation. Don't openly apply for new credit after undergoing a contract, after you have an accepted contract. Don't keep mattress money, so money in your safe or under your mattress. Don't hesitate to ask questions, no matter how large or small they may seem. Our team is here to help you and support you. Don't believe valuations on Zillow. And so Zillow and also Credit Karma. Zillow is, really to Credit Karma what Credit Karma is to credit scores. Zillow is to property values. And so a Zillow property value can be under or can be higher than what the true property value is. And the same thing for Credit Karma. Credit Karma, most of those times, those credit scores are much higher than what your credit scores are, because we follow a FICO 8 credit scoring model, not a Vantage score that Credit Karma follows. So don't go to new build communities without your realtor. So where they're building a bunch of new homes, and don't pay your collections right away. So before you ever do anything, get pre-approved first, seek counsel on what you should do with collections. If you've got a collection that hit you back in 2017 or 2015, at that point, it's really not affecting your credit score a great deal at this point. So don't pay it yet. Pay it at closing if it's required to be paid. If it's not required to be paid, then don't worry about it. But ultimately, if you pay it off during the loan process, and we need to pull a new credit score, it will count as a new collection against you because there's new activity on it. So that could cause your loan not to go through because of that. So really seek counsel on collections. So again, really the S&P Dow Jones indices, David Blitzer, he had mentioned that really house prices will continue to rise across the country. The chief economist for the National Association of Home Builders, they had said that with ongoing job creation and wage increases, we can expect continued gradual strengthening on the housing market in the coming months. So, and that is it, guys. So I'm going to stop the share here and then see what questions, if there was anything that I did not get to. Okay, so I've got student loans. The only other thing is talk about land loans to build on. So, and then let me know if you have any other questions here down below in the questions and answers. So land loans, if you're buying just the land, typically that's anywhere from, I mean, it could be 20, 30, 40% for a down payment to purchase the land. If you are buying the land and wanting to do a construction loan, then we're looking at 5% down. And that 5% down is based upon the land and the total cost of construction. So just round numbers, if you're buying a house or if you're buying land at 100,000, and then your total cost of construction would be 300,000, you're looking at $400,000 for your total package. So with that, you're looking at $20,000 down plus your closing costs. Now, if you happen to own the land, or if the land is maybe a family member's land, and they want to help you and whatnot, at that point you can, and this is really an advanced strategy, so we can talk one-on-one on this, but you can get on title to the property, and then we look at that construction loan differently. So we'll look at it as a refinance as opposed to a purchase. And with that, there's a potential that you could get into the project with literally little to no down payment or closing costs of your own. So you can talk to me one-on-one about that. Another question here. Is there a ballpark loan amount people generally qualify for based on a multiplier of income or something similar? So not necessarily. It really changes. I mean, I had one client today that they qualified for a 47% debt to income ratio, meaning 47% of their income would go towards their overall debt, house payment, taxes, insurance, and any debt that they have. But then I had another client that we're all the way down to 31%, and the path that we were wanting to go conventional, I couldn't get them approved. So 31% of their overall debt or income went towards house payment, taxes, insurance, and any debt that they have. And I literally could not get them approved. I just switched on to FHA that is a little more forgiving on debt to income. So we'll look at that, and we'll look at multiple factors, and then we'll start running you through desktop underwriter and see where we can get you approved at. But good question there. And then what is generally better to have, lower monthly revolving debt or a higher down payment? And that's really individual situation. So for some people, have lower monthly revolving debt. That's important to build their credit. For other people, a larger down payment. So a rule of thumb that you'll want to take on that is for every $5,000 increase or decrease of purchase price, that will affect your payment by about $30 a month. So, if you're looking at taking $5,000 and paying off a debt, or if you're looking, which that debt could be easily $100 a month, $150 a month, or if you're looking at $5,000 and putting it towards your mortgage and saving $30 a month, I would pay the debt off before I'd ever put it towards the mortgage. But you need that 3 to 5% for the down payment, unless you're going VA or USDA. So, and if you apply jointly, do they take the higher credit score or the lower one? It's a great question. Ultimately, if you're applying jointly with another person, what we use is we use the middle of the 3 credit scores, and whichever is the lower of the middle of the 3 credit scores. So we will look at your 3 credit scores. We'll take the middle ones from you, and then from the other person filing jointly with you, and then we'll take the lowest one. So, and then what happens with one's current lease at Columbia if you buy a house before it's due? And so that would be something that you'd want to talk to really the landlord about. I think there's buyout options and things like that, but really just talk to your landlord about that. So I don't know what happens to the lease and that. And then if you're looking to purchase in a few months, would you recommend to cover any debt before pre-approval stage or after? And what I would suggest is that if you're looking to buy in the next couple of months, let's get you pre-approved now, so we can help you do that now instead of waiting. And then we'll counsel with you as to what you need to do. So pay this debt down, or keep this, or do whatever, have X amount. Because remember, sometimes you can get a little bit better rate if you have some money in reserves after you close. And so if you have some money in the bank after you close, opposed to maybe lower debt. So we're going to look at all those factors and find out what's the best option and best factor for you. Is it better to apply individually if you're the only income earner, but filing taxes married? That's up to you and your spouse, you and your significant other. And so there's really no benefit one way or the other. A lot of times I'll have it where if the spouse has worse credit, they won't apply on the same loan. If it's the same, my wife and I were on the same loan. And my wife doesn't have income coming in on a monthly basis right now. And with that, it's really up to you guys. Now, if the spouse, the significant other, does not apply with you, and you're not on the same loan, to secure their security interest in the property, heaven forbid something happened to the person that did apply and did securitize the mortgage, we can add that other person to title. So as long as they're making the payment on a monthly basis, they don't lose the house. So that's a benefit there. Pre-approvals, I typically say that pre-approvals are good for as long as nothing changes. So let's say we've got you pre-approved today, and then in 6 months or 8 months from now, you find a house. I'll still issue a pre-approval letter. I'm going to ask just for an updated bank statement and pay stub from you. That's really it, because we have everything else. So and I may run new credit at that point. Credit reports are typically good for 120 days. But I'm not going to, at the end of 120 days, on the 121st day, I'm not going to pull a new credit report to lower your scores in that. So we'll just keep everything active, and then just touch bases with you as you're going down the path looking at properties. So, and then what's the debt to income ratio for USDA? So sometimes we can get approved up to 45%. A lot of times we're really stuck around 43%. But again, it depends upon the interest rate, or it depends upon the credit scores, really with USDA, and some of the other factors as well. Now, one thing with USDA does have income limit levels as well. And so, for instance, we had a client that he was wanting to buy a house in Polk County. In Polk County, the income levels were lower. They're around $95,000, $96,000 for the size of family that he had. And he made a little over that, not much, but just a little over that. So we were able to go to Yamhill County where the levels were about, I think they're 105, 106,000, and he was able to buy a house there where he couldn't in Polk County. So, so we'll look at the counties that you may be looking in and where your income level is and see, really what makes sense and that. So, and I think that's the last question there. Any other questions, guys? So I will just wait here for a little bit longer. Let's see, you mentioned previously paying student loan consistently to use the locked-in rate during COVID was consistently. So when I said paying loans consistently, that would be even though all student loans have been in forbearance, you've had an option to be able to make that payment. And so instead of letting it go into forbearance, you just make that payment on a monthly basis. And so there are some student loans that did not go into forbearance that you've had to make that payment every month for the last 5 months since we've been in this. So yeah, so there's two different paths there. What we're finding on student loans, when we pull the credit report right now, it's not showing a payment. So if you have a payment arrangement, provide us proof of that payment arrangement, and then we can hit you for just that debt instead of maybe 1% or half a point of your student loan debt. So. Can you clarify the joint with spouse and credit scoring that will be used? So again, you apply. You guys will have 3 credit scores each. Out of those 3 credit scores, we're going to use the middle of the 3 credit scores. So for you and then for your spouse, and then whichever one is lower, that's the credit score that we're going to use for your credit qualifying. So out of the 3 credit scores, we use the middle one. Whoever has the middle one, you or your spouse, will use that lower score for credit qualifying. So, and if that doesn't make sense, then let's just connect up in the next couple of days. Give me a call and that. And so my phone number, if you guys want that, is 971-304-3151. Again, 971-304-3151. And I'll shoot you guys out an email as well. So yeah. So with that, I really want to thank you guys. We've really had fun so far. This is the second homebuyer class that we've offered. We are doing a homebuyer class every other month. And then the months that we're not doing the homebuyer class, we're going to be doing a credit class as well as a budgeting class. So last month we did the budgeting class. This month we're doing the homebuyer class. Next month we'll do a credit class, and so on and so forth. So we're looking to be able to add value to you guys. We do sincerely want to help you buy a house. We want to sincerely set you up the right way to buy a house to where you're a successful homeowner. That's the biggest thing. We want to be able to set you up to where you can make that payment on a monthly basis and not have any problems with it. So, perfect. All right, guys. Well, have a great evening, and we will see you soon. Thanks so much. Bye-bye.